Hello, everyone. I'm taping this slideshow for the students of the ISTAT Professional Development Program. At that program, in the last module, I lectured about structuring, pricing, and risk in aircraft-backed loans and leases. And I promised to do a model demonstration of the Monte Carlo simulation model that we used at PK while I was there. Before you watch this video, though, I want you to watch a previous video I did on the MIDAX model, where I showed how you do a Monte Carlo simulation for standalone leases with just one aircraft and one lessee. In this particular video, we're going to look at portfolio effects, what happens when we have more aircraft and more lessees involved, and how we can model those effects. So also before you watch this video, you should have, unless you participated in the ISTAT PDP course, you should watch a video about the underlying methodologies that are used in this model. And you can watch this video that I recorded from a lecture with the University College of Dublin's aircraft finance master program. This is at the UCD Smurfit School in Dublin in 2021. And then, of course, this video here that I mentioned, where we look at single aircraft transactions. So now let's look a little bit at portfolio modeling. When you have more than one aircraft and more than one operator. So why would we model portfolios? Well, we can measure the impact of diversification in the portfolio in terms of the types of aircraft, the number of aircraft, in terms of the number of airlines, and diversification of airlines, and the spread and diversification of jurisdictions where the airlines are based. We can also use the modeling of portfolios to set aside portfolio capital. And we can allocate marginal capital to a loan release when we add that loan release to an existing portfolio. That marginal capital is dependent on what is in the portfolio before. So, for example, if we have a portfolio with only A320s to United Airlines, for example, and we add another loan or lease with an A320 to United Airlines, that's going to entail much more portfolio capital, marginal portfolio capital, than if we had a 737-800 lease to AirAsia, for example. And then modeling portfolios also means that we could measure the benefits and effects of cross-collateralization. So cross-collateralization, let me just explain that concept. It's a concept that you will find in loans. So suppose that you have two loans to the same borrower. Loan number one is secured by a mortgage over a A320, and loan number two is secured by a mortgage over a 737-800. In both cases with Delta Airlines, and we can assume that the borrower here is Delta Airlines. Now, if we do cross-collateralization, what happens is that the mortgage over this aircraft secures primarily loan number two, but also to the extent that there's any remaining value in the mortgage after we've satisfied loan two will go towards loan one to satisfy that, and vice versa. Any remaining value in mortgage one after we've satisfied loan one will go to the benefit of satisfying loan two. So this is a two-way cross-collateralization that has a very, very beneficial effect on the overall risk for the lender. So we're going to look at that. Now, in my previous video, we talked about how you do this portfolio or the simulation with a Monte Carlo technique that I explained how that works. Now, why do we need Monte Carlo simulation for portfolios? Well, this is the only way to meaningfully model interrelationships. These interrelationships are multiple. It's interrelationships between values of aircraft. So aircraft values don't move randomly. They typically are interrelated, these movements, and there is correlation in movements in aircraft values across the global fleet. Then we have correlation among airline defaults. Typically, airlines will default in clusters, more often so in a cyclical downturn. And then we have correlation between aircraft values on one hand and airline defaults on the other hand. So when airlines default, typically that's also when aircraft values are down, which has to do with the cycle. And then we have correlation between interest rates and both aircraft values and airline defaults. I think of this as a triple whammy. Very often you've seen that when airlines tend to default, aircraft values are down, but also typically interest rates are low because we are in an economic slump. And that means that we're probably going to face, if we have fixed rate loans and leases, breakage cost. So these interrelationships are illustrated in this graphic. Aircraft values here, you have internally among aircraft, the correlations. And then you have internally among the airlines, you have correlation. And then you have these correlate with interest rates, and then you have the correlation between aircraft values and airline defaults. So how do you model these correlations? Well, correlations can be quite difficult to model. In the MIDAX model, the way this is being done is that we have looked at the random numbers that are generated in the Monte Carlo simulation to determine the path of the aircraft value. This is called a mean reverting Ornstein-Uhlenbeck stochastic process. And in the previous video, I showed you how we have that random variable that will determine the movements in each time step to generate that path of the aircraft value around the expected aircraft value curve. Now, in reality, what we're doing is that we are generating 4 separate random numbers, where one is the global number, which affects all aircraft equally. Then we have one random number that affects all aircraft of the same type. And then we have a third random number that affects all aircraft within the same family, say the A320 family or the 737 family. And then you have a fourth random number that is individual and unique to a particular aircraft. These 4 random numbers are combined into a weighted random number that will affect the value path for each aircraft. So you can imagine that if we have most of the weight on the global variable, it means that it's the same random variable that would affect every aircraft in the portfolio, and you can have very strong correlation. Then, of course, you have other influences on the aircraft value path. You have the general price uncertainty, and you have the maintenance condition of the aircraft that is quite bespoke for each aircraft. Then, on the other hand, on the obligor default side, the random numbers or random number that is generated to determine the obligor default time is again something that consists of 3 random numbers that are weighted to combine into one random number. And so the sources for this is one random number is global, so it affects all airlines equally, then you have one random number that is regional, and that affects every airline in a region equally, and then you have the individual random number that is unique to each airline. And those will be weighted in a certain fashion so that the obligor default time is correlated among different obligors. And then you have the effect of the Perk cycle, the pent-up relative capacity shortage surplus cycle, that is global and will affect both obligor default times and aircraft value paths in the same direction. So that will also drive correlation. And then you have inflation, that is the inflation of the value of the currency. And that, of course, also has a global effect that will affect all aircraft value paths in the same way, and it also affects the yield curve in the same way. So all these different drivers will generate a correlation that is based on common influences. And I want to just to illustrate the concept of common influences in correlation. Think about the correlation that exists between ice cream consumption and drowning accidents. So it is not that eating ice cream means that you're going to drown. It's not a causation in itself, but there's a common influence, which is the temperature. So when it's very hot, people tend to want to eat ice cream, and they also tend to want to swim. And of course, if you swim, there is always this hopefully remote risk of drowning. And this creates this common influence of the temperature will drive this correlation between drowning accidents and ice cream consumption. But you cannot draw the conclusion that one causes the other. It is due to common influences. And this is what we're trying to replicate in the MINEX model. So here I've marked with a red circle the drivers that drive the correlation in red, and then you have yellow and green. It's a somewhat driving correlation, and then the green ones are random variables that will not really drive the correlation because they are bespoke and unique for each aircraft or each object. So the random variables that are generated to create the aircraft value path, they have the global source, the family source, the type source, and the individual source. And then those random variables are then weighted in a certain manner and then combined into one weighted random variable in each time step along the horizon of a portfolio or a transaction. Now, these weights are quite difficult to establish. And the way this was done at PK was we had an intern that spent the summer in Luxembourg, a former ISTAT PDP student. And she looked at time series of ascend current market values quarterly over many, many, many years, and looked at how the movements in current market values were correlated between aircraft and within aircraft types and aircraft families. And these weights that PK applied, this is a step. This is very difficult to really pinpoint, but it is so there's a lot of uncertainty in these allocations of weights, but the correlation effects are so strong and important in thinking about the portfolio that it is certainly better to have a stab at it than just ignore those interrelationships and correlations. When it comes to the randomly generated variables to determine the default time for airlines, then so we have the global variable, the regional variable, and the individual one. that is unique to each airline. Here the weights were 50, 20, 30, and this same intern who did this, and the data she used was time series of expected default frequencies for airlines by the KMV Corporation. That's a company that were giving you credit ratings expressed as expected default frequencies that used stock price volatility and stated liabilities on the balance sheets of corporates. This company was subsequently acquired by Moody's, but it was very interesting because this is an objective measure, a statistical measure of default risk. And by looking at the variations in time series of expected default frequencies, our intern could then estimate a weight to be assigned to these three buckets: the global, regional, and individual. Again, it's a stab, but it's important to make a stab and not just ignore this correlation that is very, very visible in our market. The way then these different weighting data is entered into the MIDAX database. I've shown here a screenshot of the database manager. You can see here how we have the global simulation part for aircraft, 60%, the individual part is 10%, and then the aircraft group is 15%, and the remainder is with the type. And then on the obligor side, you have the global part, 50%, and then you have 20% by region, and then the remainder 30% is individual by default. Okay, so that's the background to the correlations that we have in the portfolio that we have to model. And now we're going to look at an example of portfolio effects in a portfolio with 4 leases. And let's look at those 4 leases first, and individually run on a standalone basis. There is lease 1, lease 2, lease 3, and lease 4. Okay, and in MIDAX, you can then read in those 4 leases into a deal directory here, and then you have a portfolio simulation sheet in the MIDAX model where you can decide which deals you're going to include. So if it's lease 1, for example, then we run just lease 1. Lease 1 here. This is the result of lease, sorry, scrolling too fast. Sorry about that. So lease 1, run on a standalone basis. It's a A320-200 Neo. Okay, these are all fictitious deals. And it is leased to an airline with a B+ rating. It has 100% maintenance reserves, et cetera, et cetera, et cetera. What you need to look at is that this particular deal has risk-reward ratio of 8.3%. Okay, so keep that in mind, 8.3%. And then lease 2, here we have a 737 MAX 8 to a different airline with a different rating. It's a slightly better deal. It has a risk-reward ratio of 4.6, which is better. Less is better. Means less risk and more reward. And then we have the third lease, lease 3, is an A220-300 on lease to airline 20, which has a B- rating based in Asia. And this lease has a 9.1 risk-reward ratio. And then the final one, lease 4, is for a wide-body 7879 to airline number 50, a BB rated airline. This one does not have maintenance reserves, but it has return conditions here, as you can see at the end. And the risk-reward ratio is 12%, pretty high, which is kind of typical of wide-body leases because there's more volatility in the values of wide bodies, as we saw in the previous video. So in the base case, I run these 4 leases as a portfolio. And you will see here that the risk-reward ratio for this portfolio is 4%. That is lower than any of the risk-reward ratios for the individual constituent deals. So why is that? Well, the explanation is that we have the effects of diversification. We have 4 different allies, we have 4 different jurisdictions, and we have 4 different aircraft. And the chances of all 4 allies being in a very, very bad spot at a particular point in time, value-wise, or all 4 airlines defaulting at the same time, or all 4 jurisdictions being really bad at the same time, are very, very remote. So in all likelihood, maybe 1 airline that defaults, but 2 or 3 are going to survive for the time being. Or maybe 1 aircraft value is going to be very low because it's due for a major overhaul, but the other 3 aircraft are going to be in better condition, etc., etc., etc. So the correlations are less than 100%, and therefore this diversification effect will have a beneficial effect on the risk-reward ratio in the overall portfolio. Now, this was run with the base case when it comes to the weights allocated. Now look what happens if I say that 100% of the weights are with the individual buckets, the individual bucket for aircraft and the individual bucket for airlines. Now, of course, there is still residual correlation based on inflation modeling and the perk cycle. However, the risk-reward ratio in this case is 1.7% against the 4% we saw when we had the base case. Now, this is, of course, because we have much less correlation. It's much more independence in the behavior of aircraft values and airline defaults. But again, this is unrealistic. This is not what happens. This is just something I show you for illustrative purposes to show you how sensitive this allocation of weights are in the random parameters that the Monte Carlo simulation is using. If I then, on the other hand, put all the weight on the global, the global aircraft, all aircraft, or all airlines, and no allocation on the type or family or individual, and no allocation of the weights to the random variables on the regional and the individual. Everything's global. You have much more correlation. And then, of course, the risk-reward ratio will be higher, more risk. There's still some diversification going on here because you, of course, have the maintenance condition of the aircraft are different and quite independent. And then you have the instantaneous price uncertainty that I explained in my previous video that is bespoke for each aircraft and so on and so forth. So this just shows you the sensitivities to the allocation of these 4 buckets for aircraft values and 3 buckets for airline defaults. So to just overlay these different examples on the same chart, if I run lease number 1 on a standalone basis, this is my cumulative probability net present value chart on a logarithmic scale. And you can see here the loss tail, the loss probability, etc., etc. Now I add lease 2, but I'm scrolling in the wrong direction. I add lease 2 now, but I just aggregate the cumulative probability diagram as if each deal was run on an individual basis without regard for portfolio effects. And then lease 3, and lease 4. So look at this black dotted line. These are the 4 leases aggregated when they are run on a standalone basis. Now, the way this is done is that I have to invert the cumulative probability NPV diagram. I have to interpolate in the cumulative probability axis and then invert back, and then I can generate this chart of the 4 leases run individually and then aggregate. So look at this dotted black line now and compare that. This is the line. Compare this to what happens if I run as a portfolio with the base case common influences. And here are the base case common influences for aircraft, and here they are shown for the obligor default correlations. You can see that the whole NPV diagram shifts to the right. In other words, less risk, less downside. Okay, so there's a whole shift here from the left to the right, which means much less risk. We have a lower probability of risk overall. And if I use 100% global influence, you can see that the shift is less important. And if I had 0 global influence and everything on the individual buckets, I will have a more pronounced shift. But the black line represents something that is probably in the ballpark of how these correlations really look like in real life. Of course, like everything else in this modeling, these steering parameters are something that have to be recalibrated based on outcomes which have to be updated. And here I see great promise in AI, where all these outcomes can be fed back into a database, and AI can recognize patterns and calibrate and update steering parameters continuously over time. When you do this manually, it's quite labor intensive. I mentioned the intern we had. She worked for a whole summer, 3 months, to come up with the first step. But this has to be done on a continuous basis. Okay, so just note that the industry cycle, the pent-up relative capacity shortage surplus cycle perks, the inflation and the yield curve is always global. And also remember that the aircraft maintenance status and the instantaneous price uncertainty are always completely bespoke to each asset. Although there has been a debate a little bit about the aircraft maintenance status. You may say that during COVID, for example, because so many aircraft were on the ground, they didn't consume maintenance status, and there may have been some kind of correlation. But again, that is not accounted for in the MIDAX model. Now, in my previous video, I didn't really talk about loan and loan portfolios. So I'm going to go over that here. And there are some aspects of loans that I'm going to show you in MIDAX that are not really related to portfolio effects, but because I hadn't treated it in my previous video, I wanted just to mention that. So again, I have 4 loans. Loan 1, loan 2, loan 3, and loan 4. And what you can see about loans, of course, is that the outstanding loan, this is the principal amount here, is less than the value of the collateral. So I have a loan-to-value ratio that is less than 100%. That is typical for senior loans. And also what is very typical is that if you look at the NPV distribution, there is a bounded upside. In a loan, there is an upper limit to how much money you can make, but it's bounded by the fees and the margin income. But then, of course, you have the downside risk. And typically, you have less loss probability. Here, this intersect with the 0 NPV axis is is lower. So that's the other thing is that most loans have there is an ability of the borrower to prepay, and so this is shown here in the obligor survival and non-prepay probability risk profile. So the blue line is the cumulative probability of non-prepayment, of non-default, of survival, and the green one is the cumulative probability of no prepayment. Okay, so in this particular case, we have an almost 60% probability that the deal will be prepaid before maturity, and we have then about a 20% probability that there will be a default during the term. Then you can see here that most of the risk in this loan is with the balloon position. There's a non-recourse balloon. Risk-reward ratio is 6.4%. The aircraft is a 320-200 neo. The rating of the airline is B+. Okay. Loan 2 is a 737 MAX 8. Risk-reward ratio is 7.1%. Loan 3, Airbus 220-300. These are the same aircraft as in the 4 leases and the same airlines. It's just that it's a loan instead of a lease, so you always have a loan amount that is lower than the aircraft, not always, but in the expected aircraft value is higher than the outstanding loan amount. Risk-reward ratio of 5.3%, and then the 4th loan is for the wide-body 7879, 50. And you can see again the high risk-reward ratio here, which is typical for a wide body. Okay, so if I now read those 4 loans into the deal directory in MIDAX, and I then select all 4 loans, meaning that I'm going to run these as a portfolio, then I get the following portfolio results. So the overall risk-reward ratio is again lower than the risk-reward ratios of the constituent deals. Here you can see that the cumulative exposure in my loan portfolio drops down here after a while, and that is because there is one loan that is a full payout loan that is longer than the other 3. And this is also why the cumulative probability of non-prepayment drops down at the same point, and the cumulative default probability jumps up because the remaining airline in this portfolio was that airline for loan number 4, which has I think it was a BB+ rating, right? So that was actually a higher chance of surviving. That's why you have a jump up, because otherwise for an individual airline you can never have a cumulative default probability that jumps up, but on a portfolio of course you can have that. Okay, now I want to demonstrate the effect of cross collateralization. I showed you what that concept means. The way you model that in MIDAX is that you define a cross-collateralization pool between the loans that are cross-collateralized. In this case, we have a partial cross-collateralization. It's a two-way cross. In other words, every deal is a giver in a default situation. So if there is a default, that loan will give to the other loans in the portfolio. And giving means that any overvalue in the mortgage is going to be put aside on a non-interest rate bearing deposit that is going to constitute collateral for the remaining loans in the portfolio. Now, in reality, it could also be that the loan amount is being reduced, but the way this modeling is done in MIDAX is that the overvalue in the mortgage is deemed to be put into a non-interest rate bearing cash collateral. And then all 4 loans are takers. In other words, they benefit from the cross protection that is given by the other loans. So this is a two-way cross. However, if a loan matures, then that mortgage will be released and there will be no retention of overvalue in that particular mortgage. And if the loan is prepaid, then we have what we call an overage payment to prevent a borrower from cherry-picking loans from a cross-collateralized portfolio and prepaying the loans that have the lowest loan-to-value ratio. Then the lender can stipulate that the borrower has to prepay not 100% of the notional amount of that loan, but 120%, where 20% is put aside as a non-interest rate bearing deposit to secure the remainder of the loans. So if we have that partial cross-collateralization, you can see that the risk-reward ratio of the portfolio goes down to 2.6%. So a marked improvement. And if we now do a full cross, in other words, we have also the cross benefits remaining at maturity of each deal, and the give in prepayment, I just put here 1,000%, because that means in reality that any overvalue in the collateral against a particular mortgage will be set aside to a non-interest-bearing deposit to constitute collateral for the remainder of the loans. And if we have that full cross protection, then the risk-reward ratio will be even lower, so even more benefit. So to summarize, if we have no diversification at all, so we run the 4 loans on a standalone basis and aggregate the cumulative probability NPV diagram, we get this black dotted line. And if we now do run the 4 loans as a portfolio with the base case, so accounting for diversification but no cross-collateralization, we get this black line. And if we have the partial cross-collateralization, we get the green line. So you can see there's a further shift to the right, over and beyond the effect of diversification. And if we have full cross-collateralization, that shift is even more pronounced. That's the dark green line. Now look at this. You can see on this chart that the effect of the cross-collateralization really is for the moderate losses. So in other words, it doesn't do anything for the kind of good cases. So in 90 to 92% of the cases, that won't make a difference. But then here, when there are loss scenarios, you definitely get a better outcome when you have the cross. But when there is extreme losses, again, there is no help or benefit from the cross-collateralization. Simply when the shit really happens, there is no help. But in the kind of mid-range where you have moderate to kind of normal losses, you have a clear improvement from cross-collateralization. Now, the effect of this cross is very dependent on the constitution of the portfolio. And what I showed you in the past with these 4 loans, for loan 1, 2, 3, and 4, we had loans that were relatively equal in terms of the LTVs and ratings and so on and so forth. But if we have an uneven portfolio, so I've modified loan 1 and loan 2 here, and taken down the loan amount so that we have a very low loan-to-value ratio in loan 1 and loan 2, and then I put an equivalent amount of money in addition to loan 3 and 4, so we have very high LTV. You can see that the risk-reward ratios here are very bad on these 2 bad loans, and very low and very favorable on the good loans. So if I run this portfolio with no cross, okay, this is still very, very bad, because now I've actually contaminated this portfolio with 2 very bad loans. And if those generate losses, I'm not helped, because I can't recover those losses from the earnings from the first 2 loans, because the earnings are limited. But if I do cross-collateralization, you can see that the risk-reward ratio goes from a negative number to a very, very favorable risk-reward ratio. So the effect here is very, very strong. You can see here for the uneven loans that the shift from the uncrossed portfolio to the crossed portfolio is dramatic. Compare these 2 charts here. Here's the even loans, where you had the green area is the shift to the right of the NPV distribution, and here this green area is much, much more pronounced. So the unevenness of the loans in terms of the riskiness really, really drive the benefit of cross-collateralization. And this is a technique that lenders very often use when they have repeat business with the same borrower. So say, for example, you did finance an aircraft for an airline 4 years ago, and they come back to you and want to finance another aircraft. And you say, well, we can't finance that much money. And they say, well, you can use the over-collateralization collateral we have on the first loan, because now after 4 years, we have partly paid that loan down. The aircraft value has held pretty well, so there is a very low LTV ratio on that loan. So maybe you can use that mortgage to secure this new loan, and you can finance a higher amount. I'll come back to that. First, I just want to show you the effect. And this has nothing to do with portfolio effects. This has to do with the concept of non-recourse and recourse balloons on loans. So in loan 3 that we had, there was a recourse balloon. So in other words, when you come to the end, the maturity, there is a balloon outstanding, but that balloon is an obligation of airline 20 in this case to repay. So as long as airline 20 is alive in that scenario, when you come to maturity, then they will pay back the balloon, and you don't have that balloon risk. And the risk-reward ratio is 5.3% in this particular case. And if you have a non-recourse balloon, in other words, here, if the aircraft value is below the balloon amount, the borrower can walk away and leave you with the aircraft and give you the keys. And you see the risk-reward ratio goes up now to 6.4%, and you have a lot of risk here in the balloon. Now, you can achieve this non-recourse feature of the balloon in 2 ways. One is that the borrower could be a special purpose company, a shell company with only the aircraft as the asset and your loan as its liability. And then, of course, there are no other assets in the company. So if the obligor, in case the airline that leases the aircraft, defaults, then there is nothing left in the SPC to pay back the balloon. So you rely only on the value of the aircraft. If you do a loan to an airline and you want to offer them a non-recourse balloon in the loan, you can just write a put option and allow the airline to put the aircraft to you at the exercise price, which is the balloon amount. And then in that way, you create a non-recourse balloon, which of course is something that the lender can do because they get a better pricing. They take more risk and they allow the borrower to offload that residual risk in their balance sheet. I also want to mention another phenomena, and that is subordination. In other words, you do a junior lending or mezzanine, or I misspelled mezzanine loans. This has a tremendous effect on the goodness of a loan, but it doesn't show up in the internal rate of return that a lot of people look at. So how do you then measure the increased risk that the junior position or the subordination entails? Well, let's look at loan 3 then. And now I've modified loan 3 a little bit in that there is no prepayment allowed. And that's just to remove prepayment risk as a factor in comparing these two deals. So I say you cannot prepay. Okay. So here the risk reward ratio is 3.1%. And this is a senior loan. In the whole loan, there's a recourse balloon. And then I subordinate myself by selling down 80% of the loan amount. So now my remaining tranche that I analyze is only 20% of the original loan amount. And the remainder here is something that I have sold down to a senior lender by way of participation. And in this particular case, everything is 80%. So my debt service is 80%. My loan margin is the same. I haven't changed that. The fee, the front fee I received is also 20%. So everything is proportionate. Now, this is not really realistic because obviously, if you are subordinated, you want to have a higher margin. And if you're a super senior, you can live with a lower margin. But for illustration purposes, I just kept everything proportionate. And you can see that the risk reward ratio shoots up to 26%. It's the same IRR, basically, same IRR, 5.8337, okay? But look at the, I have scrolling problems here. Look at the very marked difference in risk reward ratio. And also you can look at, for example, probability of loss. Here it's 6.2%, here is 3.9%. Okay, so this gets much worse. So sometimes, of course, when you in real life, you will have a higher spread on the mezzanine or the junior, but you always have to ask yourself, how do I price this to make sure that I have the same value in the deal? And this is very, very difficult to do unless you do Monte Carlo simulation. All right, now the next thing I wanted to show you, this is an aside, nothing to do with portfolios per se, but it's prepayments and prepayment restrictions on loans. So let's take loan 4 as an example. You can see here that there is a very, very high probability of prepayment. In other words, the probability of non-prepayment goes down dramatically. And in fact, there's only a 25% chance that the loan is still going to be around at the maturity. In fact, it's lower than that because there's also a 10% chance that they will have defaulted and that the deal will have terminated because of default. So here you have 11% risk-reward ratio. Now, how is this prepayment probability modeled? Well, there is in MIDAX a prepayment modeling that is based on empirical data of all the loans that PK had that were prepaid and all the loans that were not prepaid. And there was a regression analysis that was done to see what were the drivers of prepayment in the portfolio. And fundamentally, there were two drivers that were very, very strong. One was what we call the cash incentive. In other words, when the loan-to-value ratio became very low in a scenario, then the borrower had an incentive to prepay and refinance at a higher LTV so that they could extract more cash from the collateral they had. And the other driver was the cost incentive. In other words, when they came into a situation where they could prepay and refinance at a lower margin because the LTV was better, or because their credit had improved, or because market conditions had improved, then they would do so if they had a significant gain in net present value by prepaying, paying whatever prepayment fees there were, and refinancing at the lower spread. Interest rates in the market are not typically a driver as long as you have hedged yourself and you pass on the breakage cost or breakage gain to the borrower. But in this particular case, in loan 4, there is no protection against prepayment. In other words, there's no restrictions or fees involved. So if I now introduce restrictions and fees for prepayment, and that is something that is done in the contract sheet in MIDAX. In this particular case, I said there's no prepayment allowed for the first 1.5 years. So there's a column in the contract sheet for prepayment fees. So an N indicates no prepayment allowed. And then I have a margin of 6% for 1 year, I think it is, and then 5%, and then 4%, and then 3%, and then 2%. And then this goes down eventually to, sorry, here it's the column, 2%. Then there's no prepayment fee after in 2031. Okay, so what is the effect then? Well, the prepayment probability, actually you can see, is 0 for the first 18 months because there is no prepayment allowed. And then there is prepayment, but not to the same extent as we didn't have any prepayment fees. So now the risk-reward ratio is much better, 6.8%. So prepayment fees and prepayment restrictions are super important. I think you always have to give the borrower the right to prepay, but the question is, how do you restrict it? And how do you get compensated for that risk? Remember, prepayment is an option for the borrower, and therefore is always a value to the borrower to have that option. And it's a detriment to the lender. So here's a difference between prepayment and non-prepayment. Okay, right. Now back to portfolio analysis. We're going to look at the marginal risk-reward ratio when you add a deal to an existing portfolio. And the reason to look at this is that if you say, well, you have already a deal with a particular borrower, and you are looking at a second deal. What people sometimes do is that they look at what the situation is with the two deals combined and say, look, this looks good. All right, so we should do this. But this is a fundamental mistake, because whenever you take an investment decision, you shouldn't look at what your position is after you've done this deal. You should look at the marginal impact of adding this particular position to your portfolio. So say that we are being asked by a borrower to provide a very sporty a new loan. So they're buying an A320, 320, 200 Neo, but they want to borrow a lot of cash. They want to borrow, they want to have an LTV initially of 98%. Okay, the deal looks awful. The risk-reward ratio is 24%. It's very risky, and it's frankly not a deal that any lender in the right mind would want to do. But we have already a loan with this borrower, which is the safe O loan, where we have, this was done a long time ago. This was done in 2016, and we have been largely repaid. And the outstanding now in this particular loan, this for A321-200, is only $10 million, and the current market value is around $26-27 million. So we have a very good loan-to-value ratio of about 38%. So this is a super good loan. Risk-reward ratio is 0.6%. And the borrower says to us, you can use the mortgage in this loan, and we give you cross-collateralization to secure the new loan. So we run this as a portfolio. We have the safe O loan and the sporty new loan as a portfolio. And guess what? Our risk-reward ratio now is 21.4%, which is still way too high. So obviously, this is not a good portfolio because we cannot use the overvalue in the first loan to cover and protect the new sporty loan. But we get cross-collateralization. So in this particular case, we get a bit of a partial cross. We don't get any prepayment protection, but there is a two-way cross, and we also can get protection at maturity, which is important because that first loan, the old safe loan, matures before the sporty new loan. Okay, so when we run that loan, sorry, these two loans, when we run the two loans with this cross-collateralization, now all of a sudden the risk-reward ratio is great. It's 1.1%. So this is great. However, we're not asking the investment committee to approve these two positions because one we already have, so there's nothing that can be done about it. We're asking the investment committee to approve this second sporty loan that clearly is not beneficial on a standalone basis because there's too much risk in it. But we're asking the investment committee to approve this new sporty loan with the added benefit of the cross from the old one. So now we need to look at the marginal risk-reward ratio of the deal that we are asking to have a decision made for. Okay, so what we can do in MIDAX, and this is super cool, I think, is that you can put in the old safe loan in the portfolio, and you can put in the new sporty loan with the cross between those two, but then to remove the existence of the old loan that you already have. So that's not something you're taking a decision on, that you have no matter what. Okay, even if you decide to turn down this new sporty loan, you still have the old one that you'd already committed to and already closed several years ago. So what we're looking at here is the effect of this new step to add this loan with the benefit cross from this first one. And now you get a great risk-reward ratio. Not so much because, and it's even better than the combined portfolio, not because the risk is much lower, but you now get tremendous earning from this new loan with very good collateral. It's not only the mortgage over the aircraft, well, there was a little bit higher LTV ratio mortgage, but you have the benefit of the cross from the first one that will survive the maturity of that loan. So this is a very, very strong effect, and this can be illustrated by this feature where you can actually include loans, or leases for that matter, in the portfolio, accounting for the cross, but then removing the loan that you don't want to see on a standalone basis. So you can include positions with a negative sign. Very powerful. Okay, and then I just want to show you one last thing, and that is the effect of diversification and marginal capital. Because capital is something that you really talk about on a portfolio basis. There's no real reason to talk about capital on an individual transaction level. Because remember what capital is for. A capital is a buffer you need to have to weather unexpected losses, a very, very bad event that could happen, like a deep crisis like COVID or some really bad recession in the market. For this, you need capital. Now, for normal losses that occur in the ordinary course of business, an airline that defaults because they were badly managed, or an aircraft that lost a lot of value because it was badly maintained, that is something you use expected loss reserves for, okay, that you allocate for individual deals. But capital is something you set aside for a portfolio. However, with Monte Carlo simulation, you could measure marginal capital. In other words, the capital is still a portfolio concept, but you could measure what is the marginal amount of capital I need to set aside for adding a deal to a portfolio. And the interesting thing about the marginal capital for a specific deal is that it's not only a property of the deal itself, but it depends on the composition of the portfolio to which you add this particular asset. Okay. So if I have now a portfolio of 3 leases already, so this is lease 1, lease 2, and lease 3. So these are the leases that I had in my earlier demonstration. Okay. And then to this portfolio of existing deals, I add a 4th lease. All right. And now I will compare by replacing airline 3 with airline 14 in the 4th lease. Okay. So now this is the portfolio results, what I run. These are just effects of diversification. I have 3 leases, 3 aircraft, and 3 airlines. Okay. And then you can see sorry, I have to go back. The scrolling is kind of funny here. I have 10.1% risk reward ratio with the 3 leases. Then with the 4 leases, I add lease number 4. I have a marginal capital of 30 million. But if I add the 4th lease with the same lessee I had on lease number 2, then my marginal capital is 32 million. So it's 2 million higher if my additional lease is with the same airline I already have in the portfolio as opposed to a new airline that I didn't have before. So this is something that you can do in MyDex, is to look at the marginal capital by adding a position. Now I'm going to show you a quick demo of the portfolio model. While it's opening, it's loading the database. And it takes the latest database by default. And now I will go from the single deal mode to the portfolio mode and read the portfolio. So I have my 4 loans in a directory that I'm gonna scan now. So that is in this folder here, Matters Demo, Loan Test here. And here I have 4 loans that are being read in to the memory. These are the 4 loans that I had in my slides. I'm going to just set the analysis dates to March 31st, just to make it consistent with the runs I had in my slides. And you can see in this dialog box, I have the 4 loans that have been loaded in. And in the portfolio selection sheet, I have not selected any of the deals, but I can do that by putting a Y in the cell in front of it, like this. And then I can I start a simulation. This is only 1,000 simulations, so it's going to be a little bit jagged curves, but I don't want to make it any longer to avoid to waste your time. And here you have the charts. I have a portfolio results sheet here. Okay, so this is the same that you saw, but that was run with, I think it was 1 million simulations in the past. Okay, now if I go back to the portfolio selection sheet, I want to create a cross-collateralization pool between these 4 loans. So I take the names of these loans and I go to a tab called Pool here. Okay, and I copy those names in. So here is my name, the names of the 4 loans that go into the pool. I give that a name. I call it Pool, very original name. And I say that this is all givers, and they're all takers. But there is no giving at maturity, and there's no giving at prepayment. I can put in a cash deposit that operates against the pool if I want to. And then I check input. And then I create the pool. So now, in my portfolio selection, I have this pool here. I can also see it in my dialog box now. Under pools and sub-portfolios, I have the pool, okay, entered. So if I include that pool, let's just compare before I run it. So the portfolio output, where do I have that now? Portfolio result here. I had 6.9% risk-reward ratio when I did not have the cross pool. Remember now that there's very few scenarios, only 1,000. So this is not a very precise number. But if I now run this portfolio with the cross, here, start. Let's see what happens. You can see that the risk-reward ratio goes down. Okay, so that was just a short introduction of the actual model in live demo, but I think the slides are more important. Okay, so that is the end of my presentation. I just wanted to mention one thing. in addition when you think about portfolios. Always think when you take a decision to invest or divest in the lease or a loan, that the result that you need to measure is the incremental marginal effect of your decisions. Don't look at what you already had in the portfolio and combine it with the new thing you have and say, we end up in a good place. No, what you need to look at is the marginal effect, the consequences of that particular decision. The other thing I wanted to say about cross-collateralization and diversification is that cross-collateralization is a contractual provision. And that contractual provision is something that if you sell a loan with cross-collateralization, either by syndication or selling it outright, that has value for the buyer because they inherit that contractual provision. That has value in itself. Diversification, as we have seen in this video, has tremendous value to the holder of the portfolio. However, that value is specific to the holder of the portfolio. So when you look at valuations of portfolios, you should never include the diversification effect, because the effect of that diversification depends entirely on what assets the buyer has. And it could be that the benefits that you measure in your portfolio from particular deals or subsets of your portfolio will not have the same effect on a buyer of that subset because their portfolio composition is completely different. And the concept of diversification also goes in several hierarchical levels. You can look at a particular aircraft lease portfolio, for example, but if you belong to a big financial institution that has investments in real estate or consumer finance or whatever it is, there are also interrelationships and correlations that will play into the diversification effects of your portfolio, put into that bigger concept. So don't measure the market value in terms of diversification. That should be the sum of your individual deals, because you should think of the individual deals as the assets that you can sell. All right, that was a final word. Thank you so much for watching. Bye-bye.